All right, let's be real. 2024 did not go as planned. Mortgage rates were supposed to come down. Most people thought we would be sub 6%, many people even sub 5%, but we ended the year north of 7%. And home sales hit their lowest levels in decades. So what happened? And what can we expect for 2025? 2024 started with a lot of optimism, and the 10-year Treasury was at 3.86%, and everybody expected the Fed to start cutting earlier in the year. But that didn't exactly happen. The Fed didn't finally start cutting until September, when they did do a jumbo cut of 50 basis points. But in the meantime, we saw the 10-year Treasury yield climb all the way up to 4.7% at the high in April, only to come down and hit a low of 3.65% just before that first Fed cut. And essentially, it's been moving up ever since. So between September and December of last year, the Fed cut a total of 100 basis points, or 1 full percent. Yet we saw the 10-year Treasury climb back up and end the year higher than where we started, and mortgage rates back up above 7%. Doesn't make a lot of sense, does it? Why is this? Well, remember, the 30-year fixed rate mortgages follow the 10-year Treasury. And the 10-year Treasury started climbing based on a few different reasons. One of which was the fact that it looked like Trump was going to win the presidency. And the other was that the employment numbers and inflation were being more resilient than expected. And what put the final nail in the coffin at the end of the year was the fact that after the last cut in December, the Fed made it perfectly clear that they were on a wait and see mode going forward because inflation was stickier than expected and the employment numbers were holding up. So going into 2025, the market was expecting that we would continue with the rate cuts, and now all of a sudden we're on hold. It shot the 10-year Treasury sky high, and therefore this is where we are today. So what happens next? Well, most forecasters are expecting mortgage rates to hover in the 6 to 7% range through the entirety of 2025, with the average consensus for year-end being about 6.3%. Now, this is a stark change from what we were looking at entering last year, when, again, people thought we were going to be sub 6% for sure. And quite frankly, a lot of the forecasters and economists, after a couple of years of this yo-yo nonsense, have kind of thrown in the towel. But let's take a look at what is driving these forecasts and the overall housing market. So as mentioned previously, existing home sales hit levels not seen for decades. As a matter of fact, they hit lows not seen since 1995, ending the year at 4.06 million sales. Now keep in mind the decade-long average on existing home sales is 5.2 million. Now despite these lackluster sales, the median home price, and that's on a national basis, actually was up 6% year over year, and ended the year slightly north of 404,000. And inventory ended the year at about 1.15 million units, which is about 3.3 months of inventory. Now on the new home sales front was actually the opposite. They did see an increase in new home sales, up about 2.5% to 683,000, but they say a decline overall in home prices, down about 1.98%, finishing with a median new home sales price of 420,000. And new home inventory had 8.5 months of supply. The biggest shift for 2025 is higher for longer. As we mentioned it before, but many analysts and forecasters have what I think is basically thrown in the towel. You don't hear as many recession calls and sub 6% rates. Everybody's kind of on board for 6 to 7% throughout the year. And the question is if the Fed will cut at all, and if so, most are predicting 1 to 2 cuts at most. But assuming rates do stay higher for longer, the big question on everybody's mind is, does that mean that home prices are going to drop? Well, the answer, or if you want the consensus answer, it's no. Most analysts are predicting that home prices are going to continue to appreciate, albeit at a more modest pace. Right now, the average is for about 3% across the board nationally. Now, keep in mind, once again, just like last year and the year before, this is on a national basis. So there are pockets where we did see home declines. Again, a lot of specified areas, some areas in Florida, some areas in Texas, and some other areas. But overall, on a national level, we saw a 6% gain in 2024, and they're calling for about a 3% gain for 2025. And on the inventory front, while we did see a rise in inventory, especially later in the year in 2024, we are expecting that to continue into 2025, but not to the point where we're going to see a flood of inventory that's going to bring down home prices. Right now, the expectation is that as people get more adjusted to the higher rates, then more people, due to just general life issues, think of divorce, think of moving, job changes, bigger families, they have to move, they have to go into new homes. That's why we stay around this 4 million a year as kind of a low, but the expectation is we are going to see an increase in inventory in 2025. One thing to note is these forecasts are all predicated on the idea that they could change at any time, and therefore they will change at any time. And that's because as new information comes about, things change. Like last year, one of the reasons I had mentioned before that rates started going up toward the end of the year was the expectation that Trump was going to win. Now that seems a little counterintuitive to some because people think that Trump administration is pro-growth and that he wants to bring rates down, and that's true, but the reality is the market was looking at some of the things that he was saying on the campaign trail, and they were thinking that those items could be inflationary. In particular, tariffs. When he started talking a lot about tariffs traditionally are inflationary pressure. And so that was one of the reasons that we started seeing rates go up toward the end of the year. And we even saw a spike on the 10-year Treasury the night of the election when it was clear that Trump was going to win. Now, what are these wild cards that move the market one way or another? Well, we just mentioned tariffs. Now, tariffs, quite frankly, and I'm not going to get political on this, but I think a lot of it is just kind of pounding the chest to make some of these other countries do a little bit what he wants to do. But if Trump does impose the strong tariffs that he mentioned, especially on Mexico and Canada, then that could mean that we see an increase in building costs because we import a lot of the wood, things like that. So that is inflationary, and that could drive up rates. At the same time, deportation. If he does go along with the mass deportation, there's a high percentage of illegal aliens or not nationalized citizens that work in the construction industry. So if there's a lot of deportation of these individuals that limits the labor force for construction, then that could mean that the cost of hiring could go up, and therefore that's another item that could drive up the costs of new housing. Now, on the flip side, there's some other items that they may be able to do. One thing that's been thrown out is the idea that the FHA has a big coffer or surplus, and that they might be able, with the new administration, to bring down the MIP insurance a little bit. That could help people, especially first-time home buyers, as well as lower income people with maybe a slight decrease in interest rates on FHA programs. Another thing is some of the ideas of deregulation, which could spur growth in new developments. At least that's the idea. That also, the idea of bringing in more inventory, of course, would be a good thing overall for the housing market. So these are a couple of the things that are potential wild cards. But the real big wild card on this, which has been for the last couple of years, is not inflation, though we still need to keep an eye on inflation and make sure it doesn't take off the wrong direction, go back up. But the real piece is the labor market. And it has been the labor market here for an extended period of time, meaning the last year, maybe year and a half. And we need to watch the labor market because we've seen signs of weakness, but it hasn't broken. If the labor market does actually break, then we will see the Fed act more aggressively. They even put out in their recent statement here for the month of January, where they did not adjust the Fed funds rate, they said that they will be closely watching inflation and labor. Now, inflation, as we know, they're always talking about that, but the reality is even though it's stickier than they would like, it's not down to the 2%. It's for the most part in check. But labor, if you see an uptick in unemployment claims, specifically above the 300,000 mark for a 4-week moving average, you're going to see the Fed start to cut. So keep an eye on labor. That is the one big wild card going forward. So with all that said, I still do think 2025 is going to be a better housing market than we had in 2024. I think that as rates stabilize, and if they do stabilize, even in the 6 to 7% range, we've seen a big uptick in demand when rates go down into the lower sixes. So if we can just stabilize and stay and not have as much volatility, that will be a positive thing. I do think that there's some underlying weakness in the labor market, and I think that there is a potential that we see layoffs increase. And if we do so, I think the Fed is definitely going to be more aggressive on the cuts. They have a lot of room to go down before they get out of their restrictive stance. Therefore, I think that 2025 is not going to be a robust year, though albeit a little bit better than 2024, with the slight chance that we head into an actual mild recession by the end of the year. Stay tuned.